What if I told you there is a way to send money across the globe in less than a minute without going to a bank or giving away any personal information? Welcome to the world of Bitcoin. In this video, we'll go beyond the basics and show you how Bitcoin really works. By understanding the fundamentals, you'll be better equipped to make informed decisions about whether to invest or use it. So let's dive in. Part 1. Demystifying the basics at its core. Bitcoin is a digital currency. But unlike physical money or coins, Bitcoin doesn't have a tangible form. Instead, it exists purely digitally as entries on a distributed public ledger called a blockchain. But who created Bitcoin? The true identity of the person or group behind Bitcoin remains a mystery. Under the pseudonym Satoshi Nakamoto, they published a white paper in 2008 outlining a peer-to-peer electronic cash system and launched the currency in 2009. Now let's talk about decentralization. Unlike traditional currencies controlled by central authorities like banks or governments, Bitcoin operates independently. No single entity has control over the network. Instead, it's managed by a global community of computer users. Part 2. Understanding blockchain technology. The magic behind Bitcoin lies in its underlying technology. Blockchain. Think of blockchain as a public ledger that keeps track of all Bitcoin transactions. It's like a record book that anyone can inspect, but no one can manipulate. Transactions are grouped together in blocks. Once a block is filled, it's chained to the previous one, creating an immutable history of transactions. Each block contains a timestamp and a unique cryptographic code. This linkage ensures that once a transaction is confirmed and added to the blockchain, it cannot be altered or deleted. But why do we need such a complex system? Well, it offers several benefits. First, transparency. All Bitcoin transactions are public, and anyone can view them on the blockchain. Second, immutability. The decentralized and cryptographic nature of blockchain makes it highly resistant to fraud and tampering. And third, trustlessness. You don't need to trust a central authority because the system is designed to function without one. Part 3. How Bitcoin transactions work. Now, let's walk through a typical Bitcoin transaction. When you initiate a transaction, say sending Bitcoin to a friend, the details are broadcast to the Bitcoin network. This includes your wallet address, the recipient's address, and the amount of Bitcoin being sent. But wait, what's a wallet address? Every Bitcoin user has a public key and a private key. Your private key is like a password and should be kept secret. It allows you to authorize transactions from your wallet. Meanwhile, your public key is your wallet address. Others use it to send Bitcoin to you. Think of it like your bank account number. So when you receive Bitcoin, your public key is what they'll use to deposit the funds into your wallet. In the simplest terms, your private key signs transactions while your public key identifies where those transactions should go. Now back to our transaction. Once it's broadcast, the details are checked for accuracy, and then it's broadcasted to a group of computers called miners. These miners play a vital role in the Bitcoin network. We'll explore their role in more detail shortly. Before we move on, here's a quick recap of the key concepts we've covered so far. Bitcoin is a decentralized digital currency. It operates on a blockchain, a public ledger that records all transactions. Each block in the blockchain contains multiple transactions, and once added, it cannot be altered. Transactions are authorized using private keys and identified using public keys. Public keys are wallet addresses that start with 1 or 3. For receiving Bitcoin, and private keys are your passwords to authorize transactions. Now that you understand the basic flow of a transaction, it's time to dig deeper into how miners validate these transactions. Part 4. Miners and proof of work. Miners are the backbone of the Bitcoin network. They're the ones who validate new transactions and add them to the blockchain. But how do they prevent fraudulent activity? The answer lies in a concept called proof of work. You see, before adding new transactions to the blockchain, miners must solve complex mathematical problems. This ensures that the network isn't flooded with fake transactions. If someone tries to double spend their Bitcoin or spend it twice, miners would quickly catch on since it would disrupt the integrity of the blockchain. But why do miners put in the effort? Because they're rewarded with Bitcoin for their computational power. It's a win-win situation. Miners get paid, and the network remains secure. In technical terms, the proof of work involves hashing. Miners compete to find a hash, a unique string of characters that meet certain conditions. Once a miner successfully finds a valid hash, they broadcast it to the network. Other miners verify the hash by checking if it meets the required conditions. If it does, the block of transactions is added to the blockchain, and the miner receives Bitcoin as a reward. This process isn't just about validating transactions. It also helps achieve consensus among network participants. Consensus means all miners agree on the validity and order of transactions. Without consensus, the system wouldn't function as intended. Let's look at an analogy. Imagine you and your friends are at a cafe trying to keep track of who owes what to whom. Without a clear system, things could get messy fast. You might end up paying for someone else's coffee, or worse, someone might claim they already paid for their dessert when they didn't. Now imagine a designated waiter, like a miner, who keeps track of all your orders and bills. With a waiter, you can relax and enjoy your time without worrying about who paid for what. And that's exactly what miners do for the Bitcoin network. They provide a trusted authority to ensure everything runs smoothly. Part 5. Bitcoin supply. And having one of the unique aspects of Bitcoin is its limited supply. There will only ever be 21 million Bitcoin in existence. This scarcity gives Bitcoin several important properties. First, it establishes value. Scarcity often drives up value. If there's only a finite amount of something and demand remains high, prices tend to rise. Secondly, it encourages responsible usage. Because each Bitcoin is hard to obtain, people think twice before wasting or mismanaging it. Thirdly, it protects against inflation. Bitcoin's fixed supply prevents devaluation due to excessive printing. Governments sometimes devalue their currencies by printing more money. However, Bitcoin is immune to this problem. As mentioned earlier, new Bitcoin enter circulation at a decreasing rate. Initially, around 5 Bitcoin were mined every 10 minutes. This rate is adjusted so that new Bitcoins continue to enter circulation at a steady pace. Around 900,000 Bitcoins are currently in circulation, and this number will continue to grow until the total supply is reached, expected to happen around the year 2140. Once the supply is exhausted, the focus will shift to transaction fees as the primary source of income for miners. A halving event occurs roughly every 4 years when the reward for mining new blocks is cut in half. This halving event adjusts the rate at which new Bitcoin are introduced into the economy. By reducing the reward, it maintains a balance between the rate of new Bitcoin issuance and the demand for them. Part 6. Decentralization and security. As mentioned earlier, Bitcoin operates on a peer-to-peer network. Instead of relying on a central server, it uses a vast network of computers called nodes. These nodes are responsible for validating and propagating transactions throughout the network. To participate in the network, you can run your own node, but many users opt for light clients, which rely on other nodes for transaction data. This decentralized approach offers several advantages. First, censorship resistance. Bitcoin cannot be censored or blocked by any single entity. If a government tries to shut it down, someone else on the network can continue broadcasting transactions. Second, fault tolerance. Even if some nodes go offline or become compromised, the network remains operational. Third, resistance to attacks. Attackers would need to control a majority of the network's computing power to manipulate the system. This is practically impossible given the vast size and decentralization of the Bitcoin network. Part 7. Bitcoin wallets. To use Bitcoin, you need a place to store it. That's where Bitcoin wallets come in. A wallet is essentially software that allows you to interact with the Bitcoin network. It manages your private and public keys, enabling you to receive and send Bitcoin. There are different types of wallets, including hot wallets connected to the internet and cold wallets for offline storage. Hot wallets offer convenience, but may be more vulnerable to hacking. Cold wallets provide added security, but require more technical knowledge to use. It's crucial to prioritize security and keep your wallet safe. Losing your wallet means losing access to your Bitcoin, since ULL no longer have the private keys needed to authorize transactions. Part 8. Why Bitcoin matters. Bitcoin has revolutionized the way we think about money and transactions. It offers several compelling reasons for its growing popularity. First, financial inclusion. Bitcoin provides an alternative to traditional banking, especially beneficial in regions with limited access to financial services. Second, borderless transactions. Bitcoin knows no borders. You can send Bitcoin from one country to another without currency conversion or international transfer fees. Third, low fees. Bitcoin transactions typically cost only a few cents to a couple of dollars, much lower than what banks charge for international transfers. Fourth, increased privacy. Unlike traditional banking, Bitcoin transactions don't usually involve personal information. While transactions are public, personal details are not typically revealed. Fifth, hedge against inflation. As we've discussed, Bitcoin's limited supply makes it a potential store of value and a hedge against inflation. Part 9. Challenges and Criticisms. Despite its many benefits, Bitcoin faces challenges and criticisms. Some argue that its price volatility makes it unsuitable as a currency. Others point to its slow transaction times compared to traditional systems. Additionally, Bitcoin consumes a lot of energy due to the computational power required for mining. Some critics also worry about its potential for illicit activities since transactions are pseudonymous, meaning they're not directly linked to real-world identities. This can make it challenging to trace the source of illicitly obtained Bitcoin. Part 10. Conclusion and Future Outlook. Bitcoin is a groundbreaking innovation that has challenged the traditional financial system and continues to push the boundaries of what is possible with digital currency. Its decentralized, transparent, and secure nature has attracted millions of users worldwide. Whether Bitcoin will become a global currency or remain an investment asset is yet to be seen. One thing is for sure, it has the potential to transform global finance, and the future looks bright. Do you see Bitcoin as a long-term investment or a viable currency? Let us know in the comments below. Don't forget to subscribe for more informative videos on crypto. Stay informed and keep exploring the world of digital finance. Until next time.